In this podcast episode, the Money Guys opened by confronting a provocative idea. Even the world's worst investor can amass significant wealth given enough time and consistency. They illustrated a hypothetical scenario where an investor, perpetually investing at market peaks, such as just before the bear markets of 2007 and late 2018, would still build a substantial portfolio over 30 to 40 years. This simply because sustained market participation, incremental investing, and the power of compounding overshadow the necessity to perfectly time the market. This perspective sets a hopeful foundation for viewers who may feel daunted by market volatility or uncertainty. It emphasizes that the real key is not in flawless decisions, but in disciplined, long-term engagement with the markets. Employing strategies like dollar-cost averaging and maximizing contributions to retirement accounts such as Roth IRAs, especially when young, harnesses the power of time, a resource most underestimate. The discussions cement the notion that you don't have to be right all that often, you just have to be in. Throughout the conversation, the Money Guys underscored a major societal failing: the striking absence of foundational financial education. They revealed that most young adults enter adulthood without clear understanding of personal finance basics, a gap often widened by consumerist pressures and misinformation. Without proper guidance, many find themselves at the mercy of predatory practices, complex products, or decisions driven by emotion rather than knowledge. This gap explains why many struggle with debt, poor investment choices, or misaligned financial goals. The Money Guys highlighted their mission to fill this educational void, not by offering flashy get-rich-quick schemes, but through consistent, sound advice that builds enduring financial independence. This democratization of knowledge aims to empower individuals across income levels, from those with barely $100 to high-net-worth families. Discipline emerged as the bedrock trait distinguishing successful financial stewards from those who falter. The Money Guys painted discipline broadly, not just as budgeting, but as consistent behaviors, living beneath one's means, resisting consumer traps, and avoiding the emotional pitfalls of fear and greed. They cautioned against extremes, noting that too much fear leads to missed opportunities, while unchecked greed can plunge one into ruin. The discussion also touched on the challenge of emotional regulation within finance, illustrating how even well-educated investors can be undone by poor timing or speculative decisions. They advised listeners to cultivate awareness of emotional triggers and to remain anchored in rational strategies, reinforcing that financial success often hinges more on behavior than on intelligence or initial capital. Both hosts shared personal tales of early financial missteps that, while costly at the time, ultimately became valuable lessons. These stories ranged from funding overpriced vehicles with high-interest loans to chasing hot investment sectors like dot-com stocks, or dabbling unsuccessfully in options trading due to mistimed executions. The candid admissions humanized financial pitfalls and served as cautionary tales for the audience. Moreover, they highlighted the irreparable damage some people incur later in life through poor real estate deals, excessive personal guarantees, or unwise leveraging that effectively erase accumulated wealth. These narratives underscored the importance of prudence, informed decision-making, and the value of experienced guidance, especially as one's financial footprint grows more complex. The Money Guys shared insights into how financial complexity naturally increases with success. Early phases might involve straightforward investing and budgeting, but as wealth and responsibilities grow, so do the questions around account structures, tax strategies, estate planning, and risk management. They recommended embracing this evolution without abandoning the core principles that built the foundation. For instance, they urged investors not to jettison proven strategies like diversified index fund investing when portfolios reach 7 or 8 figures, but to adjust and layer additional tactics such as real estate investments or complex retirement plans. The emphasis was on adaptability and deliberate scaling rather than chasing novelty, ensuring sustainable growth while safeguarding capital. Risk-taking was addressed with nuance, outlining how younger investors could and perhaps should take more aggressive positions, given their time horizon and ability to recover from losses. However, leveraged products like triple-leveraged ETFs were named as potentially detrimental for typical investors due to mathematical decay and timing risks. The hosts urged that speculation should always involve money set aside for play, not essentials. Conversely, for those accruing significant wealth, a shift toward capital preservation and diversification becomes paramount. Concentrating too much wealth in volatile assets, such as cryptocurrencies or singular stocks, can bring financial and emotional devastation. They stressed the importance of an anchor, a safe, diversified base, and advised caution before taking outsized speculative positions that might imperil years of prudent planning. In a counterintuitive yet compelling insight, the value of holding cash, especially excess cash beyond emergency reserves, was extolled. Having dry powder creates strategic flexibility to capitalize on distressed market conditions when others are forced to liquidate, unlocking deal-of-a-lifetime opportunities. They cited recent commercial real estate purchases made possible by liquidity during downturns as such examples. The conversation acknowledged concerns about systemic monetary policies, rising national debt, and inflation, but maintained that economic cycles and market corrections will continue, emphasizing timing. The market is futile. Instead, they advocated consistent investment engagement, augmented by a cash reserve, to weather volatility and harness inevitable rebounds without succumbing to panic-driven mistakes. The podcast delved into the transformative and sometimes unsettling effects of artificial intelligence and technological advancement on careers and industries. Both guests highlighted that while AI threatens to commoditize certain skills, it simultaneously elevates the value of human connection, emotional intelligence, and community building. Service-oriented professions, especially those requiring interpersonal skills, are likely to flourish or evolve. They urged embracing AI as a powerful tool to amplify productivity rather than resisting it, advice applicable to all sectors, including finance. Yet, they also raised concerns about job displacement, societal adjustments, and increased prevalence of sophisticated fraud enabled by technology. Hence, adaptability, continual learning, and ethical vigilance remain crucial as the economy and workforce evolve. A critical segment was devoted to the challenges and considerations surrounding home ownership in today's economic landscape. The money guys framed buying a primary residence more as a lifestyle and long-term life decision than a pure investment. They recognized high prices, elevated mortgage rates, and market uncertainties, but emphasized the importance of aligning home buying with personal goals like starting a family or establishing roots. They compared homeownership to a use asset rather than a growth vehicle, cautioning against overleveraging or treating it as the sole path to wealth. They drew parallels to college education in terms of both being valuable to many but not universally necessary, advocating for intentional decision-making supported by realistic assessments of affordability, expected time horizons, and personal circumstances. Addressing common skepticism, the money guys clarified that while investing in index funds is straightforward, the broader financial planning landscape involves complexities that often warrant expert assistance. Advisors become valuable when finances grow large enough that mistakes have heavy consequences, when life's financial aspects, taxes, estate, investments, become intricate, or when individuals simply lack the time or inclination to manage details themselves. They defended their fiduciary model based on client-centered advice without product commissions, and explained why ongoing advisory relationships outperform one-off consultations. The conversation demystified how financial advisors get compensated and reinforced that quality advice is a meaningful safeguard, not a frivolous expense, once financial stakes are substantial. Anchoring the dialogue was an exploration of money's limits and the true essence of wealth. The money guys stressed that money, while a crucial tool, is no substitute for fulfillment derived from relationships, purpose, and impact. They expressed joy not in accumulation for its own sake, but in the ability to help others, experience meaningful milestones, and build lasting community and memories. They warned against chasing ever higher benchmarks, believing wealth alone guarantees happiness, citing stories of those who acquired fortunes yet felt empty. Instead, they encouraged viewers to define their own standards of living, prioritize intentionality, and balance financial goals with a life rich in connection and meaningful endeavor.